Hello, I'm Tom Hall and we're here at London Square 9 Elms with Gladys Yao, our UK tax specialist, and we're here for our Tax Smart Q&A. So one of the really common questions that we get, Gladys, from a first-time buyer or someone looking to buy in the UK is if they purchase in the UK, does it impact their tax commitments worldwide?
Definitely no, but if they earn money in the UK, then there will be some tax.
Okay. And what can they expect to be taxed on?
Oh, well, net profits generally, if they rent the property out. So if they don't rent the property out, for example, if my children's going to school and I just want to buy a place for them to come during term time, outside term time, then they're not renting it out, they're not making money, so there's no tax.
And is there anything that they can claim back from tax or be exempt from tax on?
If you are not making any money, then there's nothing that you can claim and there's nothing that you need to pay. But if you are making money, then all the expenses that relate to running the rental property as a business will be claimable. So for example, repairs and maintenance, the agent's commission, building service charges, insurance, that anything that relates to running the property as a business is allowable against the rental income.
So with a non-resident looking to purchase in the UK, is it best to purchase the property in their own personal name or in a company name?
Well, if we're looking at mum and dad buying a property for their children to use when they're in school in the UK, then I would say never buy it in a company name. If you do, you trigger other types of taxes that is taxable by the UK government. I personally prefer, unless you're buying 10 or 15 properties, using individual names, multiple individual names, mum and dad and 2 children over 18, or that will be more tax efficient. Although some people won't think so, but it is, and it works out more tax efficient.
And if we had a buyer, say, who were purchasing multiple units, potentially across a number of developments, and they did want to purchase them in a company name, is it better for that company to be based in the UK or based overseas?
Overseas. The reason being, UK companies are within the jurisdiction of, obviously, the UK government. Whereas at the moment, non-residents can extract profits without paying additional tax. That can change. Whereas if you set up the company in Singapore or Hong Kong, the tax jurisdictions in those places are a little bit more friendly. And you could probably, at this point in time, extract dividends, extract profits without paying additional tax.
Understood. So there's less risk of the unknown with a company based overseas.
Correct.
Another really common question we get from our non-resident or overseas buyers is if they were to sell a property in the UK, do they pay capital gains tax on the proceeds from the sale?
Unfortunately, yes. Every person that owns property, so every property owner that sells the property, unless they have lived in it as their primary residence, will have to pay capital gains tax. Non-residents, if they purchase the property before April 2015, the gain prior to April 2015 is exempt from capital gains. Any profits they make after April 2015 to the date of the sale, they will have to pay capital gains tax. The only thing that is exempt would be if it was their primary residence. Non-residents, non-tax residents cannot claim primary residence in the UK because it is not their primary residence.
Okay. And what was the significance around the April 2015 date? How come that was pictured as the date that we take that value from?
The reason is, prior to April 2015, as a non-resident owner of a property in the UK, you paid no capital gains tax. So whatever money you made up until that point, you didn't have to pay tax. So they brought in the capital gains tax from April 2015 and decided to be generous and told overseas buyers that whatever you earned prior to this date, we won't tax you. But after that date, we will.
So a question we get a lot, especially for parents who are non-residents purchasing possibly for children or purchasing for themselves in the UK, is what is inheritance tax and who is subject to it?
Inheritance tax applies to all assets in the UK. So whether you're a resident or a non-resident, it applies to what you own in the UK. So for example, the property that you bought, a UK bank account, many people forget about that. Everyone is subject to inheritance tax on their UK assets. However, if dad or mum were to leave their assets to the spouse, so Mr. Wong leaves it to Mrs. Wong, then there is no inheritance tax. So the only exemption from inheritance tax is when a spouse leaves the property to a spouse. If Mr. Wong leaves it to his son, there will be inheritance tax.
Okay, and sort of that naturally leads us on to the point of wills based in the UK and creating a will. Is there a need for an overseas resident to create a will when they own a property in the UK?
It's a yes and no answer. There's so much yes and no answers in all this. Okay, a will in the UK directs the government who the property or the asset is to go to. It does not exempt you from inheritance tax. So if Mr. Wong did not leave a will, either in his place of residence or in the UK, then he will be subject to UK's inheritance tax rules, i.e. who would inherit if Mr. Wong died without a will. So what I say to people is, if you have UK assets, and I'm talking about assets, so a building, cash in a bank account, in a UK bank account, those are UK assets. They should have a will because the will direct the government where the money and the property will go. And that will save, in the long run, inheritance tax.
Another really common question, and probably the most common question that we get from our overseas buyers, our non-resident buyers, is if they own a property in their home country or another country and they're yet to have purchased a property in the UK, are they subject to the additional stamp duty rate when they do purchase in the UK?
Yes. As non-residents, they will pay an additional 2% called the non-resident tax. And then if they also own properties in their home country or an investment property in another country, they will have to pay the 3% surcharge. So in total, a non-resident purchaser could probably pay up to an additional 5% in stamp duty.
And if they were to purchase maybe in a son or a daughter's name who didn't already own a property overseas and didn't own something in the UK, how would that impact that stamp duty rate?
Well, then they won't pay the 3% surcharge, and if they are non-residents, they pay the 2%. But if they are resident in the UK because they are living here, going to university here, or working here, then it would be they would be residents, and therefore they don't even pay the 2%.
Fantastic. And then in that case, they'd be seen as a first-time buyer in the UK.
Correct.
And be subject to that rate.
Yes.
Brilliant. Gladys, I'd like to say thank you for your time and your expertise on the tax questions we've had today.
Thank you for having me.